This is episode 33 of Zen and the Art of Real Estate Investing with my guest, Dave Meyer, the VP of Growth and Analytics at BiggerPockets and a real estate investor. Dave, welcome to the show. It's great to have you.
Jonathan, thank you so much for having me. I appreciate it.
Yeah, let's go back. How did you get started at BiggerPockets? And then we'll get into your investing history as well.
Sure. I was investing for probably 5 years and had also been simultaneously working in the software industry and was looking to change jobs and thought, man, I really like real estate. I really like software. Why don't I look for a real estate software job? Googled it. I had never heard of BiggerPockets. And it turns out that the office was about a mile away from a triplex I was house hacking. I didn't know it was called house hacking at that time.
Yeah, right.
But I was just invested on my own. And I was like, oh my God, this is amazing. So it took like 9 months. It was a small company back then and took about 9 months before there was a job that I was qualified for, but applied, got it. And that was almost 7 years ago to the day.
I think that people get a little bit too obsessed with like, quote, the deal. So they end up going too much, farther away when if you just paid a little more, you could like create your first year of managing the property be so much easier. Like you're saying, you're
Totally.
close, you can react to things quicker. You don't have to find someone in an area that you don't know. So that's interesting. I know some people complain about their markets, but you were doing this in Denver, which even in 2010 was still a hot market. It was just a lower hot market than before. Did you ever go ahead?
I was just going to say, I'm a firm believer that one of the benefits, if not like the greatest benefit of real estate investing, is how flexible it is and how you can adjust your individual strategy based on the lifestyle that you want. And for some people, it's like, I need to maximize the best return and I'm willing to drive or hire a team in, this suburb and this suburb and manage all of them. That's never been me. I've always kind of just been like, especially, working full time. I was like, I just want to make this easy for myself. And like, Did I give up a point in cash on cash return? Maybe. Do I regret it? Absolutely not. I feel like it allowed me to do other stuff I'm interested in my life. And so I think to your point, it's really just about like figuring out what you want and like trying to make it sustainable for yourself. Cause like if you make it sustainable, you could do it for longer. And as everyone who understands compound interest knows, like the longer you do it, the better. So it's really just about making it something that you enjoy. And I think that's often overlooked.
Yeah, you said something so important that the analytical nature of what you're doing is to help people make decisions, you included. But I think that's so important because I remember when you started writing the longer form articles on BiggerPockets, and I was like, damn, we were talking about this before, but like, this is like the information that I want. And, BiggerPockets is a conglomeration of a lot of new investors, but then a lot of seasoned investors, like us who've been around for a while and really want like a little high-end portal. And I think when you started doing that, it really like helped everybody because I think like newbies can look at the data and really take something from it. And especially like personality wise, like if you know the DISC test, if you're a high C, I'm just like read all that. Like I love spreadsheets too. I just want to like look at it and, work the calculations and see it. But I think even for the other personality types, once they develop a trust level with the person doing the data analysis, they can just look at it quickly and say, okay, well, Boston's in the top 5. So let me just go to Boston.
Yeah, exactly. I think there is different personality types. Certain people, take comfort or gain confidence to be an investor from, having a mentor, for example. For me, I've like never even considered that. For me, I like trust numbers. I like numbers. And I'm like, if I could, I got to trust my own analysis. And like, if I build out a spreadsheet and feel good about it, like I'm going to go for it. And I think there's just different types and both are useful. And I think everyone needs some level of analysis, but I found that for a lot of people, it does help them get over like the hump, especially beginners for the early hump, just like understanding that it's not gambling, like there are predictable returns, there are predictable outcomes, despite, recent evidence over the long run, housing is relatively stable, predictable asset class. So I think that's really helpful for people. And then, as you know, Jonathan, like as you become more advanced, you're constantly trying to evaluate how to reallocate your capital, how to balance your portfolio. And the best way to do that is just by having a firm understanding of what your options are and you know, and what's happening. And that allows you to sort of continue to build a strong portfolio over time.
So I've always said that it's great to use, if you're good at analytics, but you have to get out in the field and see it. And then once you start seeing stuff, those spreadsheets that you have become so much more valuable because you're taking the data and attaching it to real life. And then you know what $250,000 smells like in your area. You know, it may not smell well. It's not going to smell good in some areas, but 250 somewhere else could be super high end. So do you agree with that? That like what we do as like kind of data nerds is so important. But I think like newbies, they get like, they say like, I've looked at 40 deals this week, and you ask them how many they saw and they say 0. And it's like, well, you're not really going to know anything until you see them in person.
Totally. I think you have to add that contextual nature to it. You know, when I first got started in real estate, you know, it was the sort of the bottom of the market following the recession. And as you probably remember, everything was on the market. There's so much inventory.
Including a couple of my houses in Florida.
Sorry to hear that. But, you know, it was kind of this thing where, you know, I didn't have a lot of money. I waited years between investments, but I would still like, you walk by an open house, I'd go into them all the time. Yeah. I've been in probably hundreds and hundreds of open houses that I had never had an intention of buying. You just get a sense, talk to the agent, like doing that stuff. You get a real sense for what things cost, how popular it is. You even overhear what other people like about the house, what they don't like about the house. And I think it's been hard for investors the last 2 years through the pandemic. One, because at first, like showings were all weird because of the regulations. But then, in other words, they weren't even doing open houses because there's so much demand. The selling agent didn't even need to do it. I think now we're entering a time when, you know, agents are going to have to be more accommodating to buyers. And I highly recommend to people, just go stop in a house. I just did it today. I live in Amsterdam. I'm a renter. I have no intention of buying, but there was an open house. I was just curious. So I just went into it just because I like looking at houses. So I just really encourage people to do that, because then, you know, it gives you that frame of reference. Like you said, this is what it costs. You will be able to identify like, oh, I've been in 20 houses that cost 400 grand. This one has the same price, but it's a perfect layout for a rental. You know, like that's when you're like, okay, now I know this is better than everything else out there, and this is the one I'm going to pursue.
You said something important about syndications. I think when you're in the business, you know, and you know real estate, your really operator is really important in the syndication, because you can look at the data, and if the data looks good, you're like, this is a go. But if you don't know the operator, you don't have the trust value that you need. So I've been saying on other podcasts, because we've had a lot of syndication conversations recently, that like syndication marketing can be so good, but that can be a problem, which is what we're going to see for the rest of the year. You got marketed into a funnel that's not a solid syndication, you know, or that's requiring the LPs to do more than expected. And I do think there's going to be some issues this year. And that's something you know, like you're saying, you look at the operator, you look at the data, you have a trust level. So, you know, like that's as passive as you can get as an LP, but it's fun passive to me, because you can look at it and feel a part of it when the information is delivered the right way, you know, from the syndicator.
Absolutely. And I think like, you see there, you know, the reason I like Brian's book, and I also have Brian's book right here. I grabbed it while we were talking.
It's literally right behind me.
I love it. It's a great book. You know, I think people look at like the highest IRR or the highest rate of return, and like I used to think that way too, you know, at first, and now I'm like, this person's just wrong, you know, like that's a sign that they're overly optimistic to me. Like the syndications I wind up doing, it's people who are usually underselling the IRR, and they're like, I'm going to give you 13 or 14. And in the back of my head, I'm like, they're sandbagging this and they're hoping to give us 17, but they're not going to say that because they don't want to disappoint their investors. That's the kind of people I want to invest in. I don't want someone who's like, I'm going to give you 18, but everything has to go right. You know, right? It's like, exactly. So it comes with maturity. And I think like a lot of media and personalities in real estate are like, well, multifamily, everyone wants to be a syndicator now. It's like, that's hard. It is not an easy business. And I think if you're going to do that, start with small multifamilies, learn before you start taking other people's money. Because as Brian has said, you just do one syndication, it goes wrong at the beginning of your career. That's the end of your career.
For sure. Think about it hard.